Well, welcome to Money Mindsets Matter. I'm Chad Craig. And if money doesn't matter, then what's the matter? If you're not preparing, you're not prepared. Hey, this is episode 7. And in episode 6, we talked about in debt to the eyeballs. And here in episode 7, we're going to pick up where I concluded episode 6 on, hey, what do we do with our money once we have surplus, when we've moved beyond the simple 10, 10, and 80. And so today I'm titling episode 7, Move the Money. Move the Money. When you think about moving the money, we have to deal with now investing. When you think of investing, there is short-term investing and there is long-term investing. Short-term and long-term. Now, I'll tell you up front that I'm a person that believes that all of our strategy or eggs shouldn't just be in one basket. I believe there are very few of us that can be that confident in one strategy where that's the only place our money goes. For instance, if all your money was in one vehicle, and let's say the vehicle you chose, the investment vehicle you chose, wasn't real liquid. Well, if all your money was there, you wouldn't even have access for emergency. And so we're going to talk about move the money, but what are some places on where you can begin to move the money? The first is a savings vehicle. That's simply just a savings account. You can go to bank closest to you. You can open up a savings account. And this is where you can actually allow a 3 months or 6 months or a 1 year of savings of your current expenses needed to operate monthly. Okay, so you look at your normal liabilities, your expenses, your monthly financial overview, and you can times that by 3 or 6 or by 12 and have that in a savings account, savings vehicle. In addition, there's also a money market account. A money market account. So a money market account, based on what's happening in the market and rates and interest rates, is going to predominantly give you more interest than your typical savings account. So, there for a while, last several years, a savings account was bearing almost no interest. Things have changed. Now, currently, I am a steward of a money market account. And that money market account, now with the Fed having raised rates 12 consecutive times, probably will a 13th, and then might pause for a while, but rates will stay until something breaks up. Whether you like that or not, I'm sticking to it. I'll talk more about it later, but history speaks to this, and they have to begin to create a sense of fear and try to pull back people's unguided consumerism and spending, or we're on a trajectory that most people are going to have very, very, very difficult time surviving in, because most people don't have healthy money mindsets, and things through inflation and assets have been pushed so high. The affordability of so many things are out of question for so many. So you have savings account, savings vehicle, where you can have money for any emergencies. Covers you for so many months if you were to be laid off or something. You can have a money market account. Currently, a money market account that I steward. I say steward because basically I own nothing. I am a steward now of things that God has brought into my wife and I's life because of now long-term planning for generations to come. And so we have removed ownership and from us, and we have vehicles that have done that, and we'll talk more about that in future episodes. But now we're just stewards. And so, but in the money market account that we steward right now, due to the Fed increasing rates and banks needing capital, you've had so many regional banks collapse. Several have folded. Others are still in a tight place. So banks now are needing capital to guard themselves with this high interest rate environment. And so this money market account currently is paying a little over 3% that we steward. Year and a half ago, 2 years ago, you would be amazed if you were able to find a money market account that was paying that interest. 3% plus wasn't happening. But now there's that opportunity. Another place where you can move the money is what's called CD. CD stands for Certificate of Deposit. Certificate of Deposit. Now, I have actually here, I found the other day, I was getting rid of some of our old files, cleaning out, and I saw this. This is interest income that we received off of 2 12-month CDs. And one of the 12-month CDs in 12 months, certificate of deposit, earned $360.84, and then another 12-month CD earned $598.50. Now, if you like math, you can get out your calculator and seek to estimate how much money was put into that CD and how much interest was being earned. But that was a high rate. Why was this? Well, this was back in 2010. 2010. And I know some of you, to you, I look young. And I am young. Of course, that's relative. But I am experienced enough and old enough to remember the last big crash, the housing crash. In fact, the bank that I had, my wife and I had these 2 CDs at, one of the reasons I went to them is they were close to our house at the time where we lived, but they built this beautiful big bank right during that financial difficulty and time. And I thought, man, these people, they must really know what they're doing. They're building this beautiful big bank, and financial times were tight. If you can recall what happened in 2008 and 2009 and 2007, all leading up to that housing crash. So I said, man, I'm going to put money there. What's interesting, though, is it ties into some of what we talked about last episode, is that things on the outside can appear one way and it not be the reality. And that bank, which was a small regional bank, collapsed. That bank eventually was no more. And that building that I talked about was so big and beautiful that they built during that downtime. Someone else got it at a good price, I'm sure, and moved in. But back then, the reason we had such high interest is because banks, again, were needing capital because interest rates were being raised, the housing market had collapsed, and they were needing some liquidity to cover so much of their outstanding liabilities and debts and loans that they did. So that's CDs, okay? Now, when you think about the 3 that I've mentioned so far, savings vehicle, a positive is it's liquid. So most savings account, you could say, I want to withdraw everything that's in my savings account. You could close your account and walk away with all of that capital that was in there. A negative to a savings account is you're not going to get paid much interest. So it's very, very minimal growth, but it is safe. FDIC guarantees a savings account up to $250,000 on certificate of deposit insured. All right. So it's safe, it's secure, It's readily accessible. You can make it liquid. But a negative is it's a slow, small rate of growth or return. Money market, depending on the terms, there's different types of money market. But for instance, the one that we steward and oversee, that money market, we can close at any point. And so it is liquid. A positive is it's safe. Okay, it's guaranteed. It's backed by the FDIC, and it's going to pay more rate of return or interest than your normal savings account. CDs, they are safe, secure place to put your money. The negative is they're not liquid. So there is a term of maturity for a CD. So this that I found just the other day, happenstance, these were 2 12-month CDs. So what that means is that money is tied up for 12 months. Okay, now some, based on the agreement, some liquidate, but you're going to then lose money. You're going to actually take out or receive less than you put in if you don't allow it to come to the full term of maturity. At the end of the maturity of a CD, then you get the interest based on whatever percentage was agreed upon for that CD. And so you can do a 6-month CD, you can do a 12-month CD. They have some longer term. I've done what they called baskets that are a form of CDs, where it's just a product that a bank had made, where it was a basket of certain stocks or track certain commodities, and it was guaranteed a certain interest percentage regardless of what the individual stocks or what was in the basket did. So on that one, I would say that bank actually came out way better than me, because the stocks and the things in the basket way outperformed the agreement I entered into of what interest the basket was guaranteed at the end of that. And that one basket I had for a 5-year basket. But what that meant was there was a ceiling on the amount of interest that would be paid to you, percentage-wise, and there was also a floor. So meaning the money was protected and guaranteed not to lose value, but you had to hold it to the whole term of maturity. Okay, so all the time, banks and different investment firms can create different products that you can always check on and look at. And if you're not aware of current, rates, whether it's mortgage rates, whether it's typical savings account rates or money market rates, a great tool and resource is bankrate.com. And they have calculators on there that you can run numbers and things like that, okay? Now, another place that you can move your money is bonds. And when it comes to bonds, there are several types of bonds. There's government bonds, okay? There's municipal bonds. There's bonds that are sold by cities. So, for instance, let's say a city wants to do build a new school, or they're in partnership to build a new hospital, or they have some project. Well, they can raise money through a form of debt by selling bonds. And so a municipal bond is you're lending a city, you're lending them your money for a guaranteed rate of return on the money you lend for the term that you agree upon. So once it matures, that bond, you're going to get interest from that. When it comes to government bonds, you have 3 types that I want to mention here. You have T bonds, okay? You have T notes, and you have Treasury bills. The difference is a T bond is normally 20 to 30 years till maturity, okay? And you get an interest payment biannually on the T bond. And then upon maturity, again, these are T bonds, so these are long-term, 20 to 30 years. Upon maturity, you are paid the face value of the bond. You say, well, why would I want to hold something 20, 30 years and in the end only get paid what is the face value on the bond, because it's what I said previously. Each year, semi-annually, you're receiving interest on that bond. So you are receiving money twice a year in interest payments on that bond. So every year you hold it, you're getting those interest payments. If you hold it all the way to the end, then you are paid back the full price of the bond that you purchased. Now, these T-bonds you can access directly from the government. Same with T-notes, same with Treasury bills. You go to the U.S. Treasury website and you can purchase them directly. Now, that's not the only place, because what happens is there's a secondary market for all of these. So a lot of investment firms go and they purchase a large amount of T-bonds. Okay, so they have this pool of T-bonds, 20 and 30 years, that's what T-bonds are. And then on the secondary market, okay, they can trade or sell these T-bonds based on whether the interest on them is paying up or down. They can trade, okay? And so there's a secondary market for them. So for some of you, you can access on the secondary market through different investment firms and things like that. So that's what T-bonds are, all right? Guaranteed, they're backed by our government, okay? So secure, you know what you're getting into, you know the terms, you know the maturity date, you know when the payments will be, but the interest on those payments can fluctuate based on the other things that dictate the Fed's interest rates, what's happening in the economy, things like that. Then there's T-notes. T-notes are 2 and 10 years, okay? So T-bonds, 20 and 30. T-notes are 2 and 10 years, and very similar, though. There's biannual interest paid out. If you hold it to maturity, then you receive back the face value of the note, okay? And they're sold in multiples of 100, okay? So you can't go and buy a $50 T-note. They're sold in multiples of 100, all right? And they're also sold on the secondary market. So you can access some T-notes. They are traded on the secondary market. You know, you have investment firms and things like that that are trading, day trading at times, T-notes, all right? Now, the 10-year, this is very important to remember, the 10-year T-note is the benchmark rate for banks to use for determining mortgage rates. So if you want to grow in your mindset of having knowledge and wisdom when it comes to money and the economy, you want to become more and more aware and attentive to the 10-year T-note. Why? Because whatever the 10-year is currently trading at, its price, that is the benchmark for the banks to determine what their 30-year or 15-year or 10-year mortgage rates are. So the higher the 10-year T-note goes, the higher the banks are going to set their mortgage rate, okay, and their mortgage products for home lending, home refinancing, things like that, all right? So obviously right now, if you're aware of what's happening, is the 30-year, they've even created a new product because of people being pushed out of the affordability of housing. They've created a new product. First time that I remember in my 40-plus years of living, a 40-year mortgage. 40-year mortgage. So all of that rate right now, 30-year, is over 7% right now at the time of this filming, okay? What determined it to be so high? The 10-year T-note. 10-year T-note is paying out very high interest, okay? And so That's the benchmark rate that the banks use. So we've talked about T-bonds, T-notes. Then there are Treasury bills. Treasury bills are from 4 weeks to 1 year. All right. And the uniqueness of a T-bill is you collect no interest. You say, well, why would I want to put my money there? Because listen, you collect the difference between the amount you paid to purchase the T-bill and the amount of the bill. So what happens is these bills are sold because they're a short-term product. They're sold cheaper than the amount of the bill. So let's say you have a $100 T-bill and you bought it for $80. Well, you're not going to pay interest. But if you hold that T-bill till the end of the 4 weeks or the 1 year, then your profit is the difference of what you paid for it versus the amount that T-bill is. Okay, so if you purchased it for $80 and it was a $100 T-bill, then what did you make? You made $20. Okay, so there's no interest paid. The way you make money on them is you want to buy when they're down, when they're low, okay, when they're not in demand because people are concerned that the short-term rates are dropping, and so people are wanting to buy things for longer term rates. They're wanting to lock in at higher rates for the long term. But right now we have what's called at the time of this filming an inversion. And every time, of course there can always be a first, but so far in the history of our nation, every time an inversion has happened, it has foreshadowed and came before a recession. And so we have been having a major inversion. What that means is right now the T-bills have strong demand. Okay? Right now when people think about 20 years out, 30 years out, there's a lot of unknown. Okay? There's a lot of lack of wanting to lock in to a T-bond for 20 years. That's a lower interest rate when right now you can get a higher interest rate. You can get a higher, in a sense, risk to reward for 4 weeks, 1 month, 3 month, 1 year T-bill. So right now, people can make a lot of potential money now because of what's happening with the Fed keep raising rates and no one knowing how long they're going to hold rates at this level. And so that is the difference between the T-bonds, T-notes, and the Treasury bills. Okay? So the inversion there happens as well when the T-bonds, let's say, are offering, I don't know, let's just make it up, but let's say that the T-bonds is saying we'll pay you 4% or 5% for 20 years. Well, that's attractive, because what that means is you could lock in on some of them making 4 and 5% guaranteed. That's decent. Not as far as like exponential growth, skyrocketing like a stock that doubles or 10x's, but that's steady income, especially if they get inflation to stay back to where they want it, 2%. Okay? So then what that means is now the T-bills, there's a lot of risk up front. So you have this inversion and happening. And again, all these can be accessed directly through U.S. Treasury website. Now, you always got to keep up with your bank offering different things, because there are new products, new things that they change. Just like I said, the 40-year mortgage is now something being used. I know, you have home builders. I was talking with someone that's in the home building field, their job, and this is a family housing, home building, and the builders are paying down the interest rates for the buyer, in order to sell or unload houses that are ready. So you actually have builders who are paying down, which you can always, since the first home that I purchased over 20 plus years ago, you could always buy down the rate. Okay, so you could buy down the interest rate on your mortgage, and what you're doing is you're paying additional cash up front to the lender to buy down that rate and to lock in at a lower rate. Well, now some builders are doing that for suspected buyers to try to offload these homes that they have ready to sell. So there's always things like that changing based on current environment, supply, demand, and issues happening in the economy. I remember when the time that we had these CDs, we also purchased a home. And that's why you say, well, hey, Chad, are you out there looking to buy now? Because home prices just going to keep going up and interest rates going up. No, absolutely not. You know why? Because this young buck remembers back of what happened. And I remember what they were saying then. And I'm listening to what's saying now. And I remember buying a home when the interest rates had increased. And yet, if I would have waited another month, that's when the housing crash happened. And the home I just bought instantly, right next to me, being sold for $50,000 plus less. Now listen, if you're not in a high demand market, for a house value to climb 50,000 plus back up, it don't happen overnight. If you're not in a high demand city, okay? So I'll tell more about that story at some point. But I remember when we bought the house, I should have known that things, of course I knew was tightening because the interest rates had ticked up. I think we got that home, our interest rate was maybe close to 6 when we bought that house. But our builder paid all our closing costs. I remember, I don't even remember having to show W-2s back then to get the loan. This was right before it burst. Normally the builders didn't put blinds in all the windows. That was like something that once you bought the house, you do. Put all blinds in for me. Several upgrades for free. Again, paid all closing costs, all of that. Why? Because things were starting to slow down, and that it was hitting that crest, and builders needed to start unloading what they had. So we end up, praise God, in the end we didn't lose money on that because we became landlords, and because we had put 20% down. You can't walk away at that point when you're underwater. So anyway, it's part of what I remember, and I see a lot of things now that makes me personally concerned. Now, another place you can move money is if you're in a job, if you're in a career job, meaning it's a job that really is for long-term employment, you can put money and move money to 401k. Okay, so 401k is offered right through an employer. There's different forms of different numbers and things that basically is the same as a 401k. You can ask your representative there at your work on what type they offer. But the good thing about this is early on when you're learning and growing in your money mindset and biblical understanding of a wealth mindset and where to move your money. Great thing about 401k is your employer matches. Now, every employer matches up to different percent. I talked with someone just this week, their employer matches up to 6%. I think at one of my employers before, they matched up to 3%. I think I had another one at one time, maybe 4%. And I always then, because at that point was well beyond the simple 10-10-80. And so we weren't consumers. We weren't just anything our IC want. We had no debt other than a mortgage on our property, but we had no car payments. I had paid off a small amount on the student loan that my wife had when we got married. And so we began to put money, that discretionary money, that extra out of that we had, into 401k, and we allowed the employer to fully match it. Okay. I say that because most people, probably you as well, are not going to sit down and first spend 3 months, 6 months learning all the possibilities of where to move your money and what is the best route for you, and make your strategic long-term financial planning. You're probably not going to do that. And so a place to move your money until you grow in your money mindset and what to do with your money is just start utilizing the 401k. The reason I say that too is most of you are probably not going to be, when you retire, at that same job, at that same workplace. And what that means is, at some point when you transition out of that job or workplace, you're going to have to roll over your 401k anyway. And so you then, once you leave, if you've gained more wisdom and know of more opportunities or different vehicles of where you would want to utilize or move your money, when you transfer jobs and you're going to have to roll over your 401k, they're not going to keep that 401k for you when you're no longer employed for them. You're going to have to roll it over into another vehicle. You can make changes then if your long-term planning is clear, or if you got a clear direction or plan at that point. Okay. So obviously, a positive of 401k is that you, in a sense, can get free money by your employer matching up to whatever percent they're willing to match what you put in. Okay. The negative is it's not liquid. So you can't access it without significant penalties before retirement age. Okay. In that vehicle. Now, there are ways that you can learn to roll it over into other vehicles and things like that. But okay, so these are places to move your money. Another thing I want to mention out is collectibles. So one place to move money that people sometimes forget is that you can, I think about a Steward baseball cards, a Steward figurines like G.I. Joes and things that are 30, 40 years old. Okay, so collectibles is a place that you can move money into, something like that you believe for long term at least will hold the value of the money, keep up with inflation, or even long-term increase in value at a higher rate than inflation. Okay. Another place to move money, we're going from sort of simple to a little more difficult in the sense of effort and time it takes to acquire and know what to do. The next one's real estate. The truth of the matter is real estate doesn't always go up. You just heard me say that we purchased a home, and a month or so later, the housing collapse happened. And guess what? The value of our home didn't go up then. Now, sure, if you look over the track record of America, if you extend the calendar and you look at 100-year tables, or if you looked at that long, then you can see, yes, normally the asset of homes have increased over the long term. But to say that the value of homes always goes up is disintegrous. It's not honorable. And I have many brothers and sisters that are in followers of Jesus, that are in the real estate business, and I love them. But there are times I have to bite my tongue, because realtors, for the most part, you, my friends, you all are salespeople, and salespeople are always positive. And so oftentimes you'll say, well, real estate always goes up. No, it doesn't. It doesn't always go up. And what you'll find out is the more difficult, meaning the more knowledge needed for some of these different vehicles of where you can move your money, the more understanding timing becomes important. See, CDs, I mean, timing is not that large, that important when it comes to making a decision about a CD. Whether you wait a month, wait 3 months. Why? Because CDs, for the most part, are only going to range within so much interest rates. There's not a lot of risk involved. But when it gets to some of these higher valued assets or more volatile assets like crypto or stocks that I'll mention in a moment, timing is of utmost importance. Just like I said in that one house example, that wasn't our first home, but that home, the timing of it mattered. If I would have waited a little longer, instantly would have had probably saved, well, I would have saved instantly a lot of money. Would have had more equity if I bought at the bottom instead of towards the top. So timing becomes a more important issue the more we go through this list. Now, you hold real estate long enough, historically, it's outperformed inflation and has, when you extend it out long enough, increased in value. Okay. Next is stocks. When it comes to stocks, you have the potential for high gains, but they bring great risk. So where a money market account, savings account, low risk, okay, but it's not going to be high reward, but it is safe, it is guaranteed, you know what you're getting into. Stocks have the potential, individual stocks, to have high reward, but there's high risk. Like I own NVIDIA, but I unloaded NVIDIA too early. And so I missed out on some of the reward now when it has just hit another all-time high. Okay, so stocks can be very volatile. Okay, they're risky, more risky than some of these other things I've mentioned, but there is the potential for high return, high rate of return. Now, in addition to stocks, you have types of funds. You have mutual funds. A mutual fund is just diversified. The thing about a positive about a mutual fund is the diversification helps protect you from drastic drops, okay, in value, crashes of the mutual fund, but it also limits your upside some, because a mutual fund is looking for sort of a sweet spot of consistent gains and returns, okay? So it's protecting the downside, but by protecting the downside, it's limiting how much upside it's going to have. Another issue with mutual funds is they're safer than stocks, but they come with high cost. In fact, I looked not too long ago at one of the mutual funds that I oversee and steward, and was flowing cash into this mutual fund consistently on a dollar cost average, a consistent plan. And I went and looked, and the fees were very high percentage, meaning regardless of the amount of money I was putting in monthly, they were charging a certain fee right off the bat. Now, to do that, what that means, and I knew that, but it sort of hit me. I didn't realize how much the fee was. It's like I had forgotten. I knew about the fee. But when I saw that, of course, I am using that vehicle for long term. You don't want to put money into a mutual fund with very high cost where instantly there's a service charge, okay? Because a mutual fund can't be passive. There's going to have to be someone in that firm watching the mutual fund to make sure the risk reward and the diversification is balanced, and they'll have to rebalance it at times based on what's happening in the market and the economy and things like that. So because it's got to be eyes on and managed, then there's going to be more fees to that. It's not just a passive form of investment or vehicle. So that is one of our long-term vehicles where we move money in it because we're going to steward that mutual fund until retirement. Okay, so we're not looking to take money out, or we're not necessarily looking for quick short-term gains. All right. If you're looking for quick short-term gains, you wouldn't want to use a mutual fund because the fees are going to swallow up those gains that's taking place for the most part. There's also ETFs. ETFs means exchange traded fund. And what this is this is similar to when I mentioned earlier about a basket. And what an ETF is, it's basically a basket or a group of certain stocks or certain stocks and bonds. So you can get topical ETFs. So you can buy an ETF that tracks gold, that tracks commodities, but also tracks those involved in the gold industry. So gold miners, you can have an ETF in that. You can have an ETF that focuses on, let's say, just certain tech sectors, okay? So, or you can have an ETF that tracks just certain sectors of the S&P 500, all right? So it's just the healthcare ETF or something that is a basket of stocks of S&P 500 companies that are dealing primarily just with healthcare. So that's what an ETF is. A positive about ETF is if you feel like a certain industry is got momentum, or it's advancing, or the government has just got a lot of money that they've allocated and going to pour into that industry, it allows you to be invested in that sector without constantly having to watch an individual stock or keep up, okay? And so these, of course, when it comes to stocks, mutual funds, ETFs, is you're going to need some type of broker, all right? You're going to need a broker. You're going to need a Ameritrade. You're going to need a Robinhood. You're going to need some type of exchange that can get you access to the stocks and mutual funds and ETFs, all right? Then there's commodities. What's the difference between commodity and stocks? Commodities are goods, and commodities are distinguishes for services. So when you think of a stock of a company, let's say Apple, what does Apple primarily provide? They provide services, right? So they're not providing, even though they're called Apple, they're not providing a commodity. They're not providing a good. They're providing services, all right? So they're servicing our desire for technology and phone and computers and accessing internet and working. But commodities are goods, all right? So you have cattle, and you have wheat, and you have silver, and you have good. Companies provide services. Commodities are goods, and you can invest in them. Next, you have crypto. When it comes to crypto, the chance of gains, there is potential high upside, but there is incredible risk because so many of the cryptos are just rug pulls, meaning they're people that are wanting to get momentum, get the price of a crypto to moonblast, and then they pull all that liquidity out, take their money, and leave everybody holding the bag and losing, okay? Bitcoin obviously is different than that. Bitcoin is built off of math. It's built off of a mathematical principle, okay? It's built off some premises and some values. But there's a lot of just altcoins, crypto coins, because there's limited regulation. People can just create a crypto coin and begin to market it and begin to sell it, and people can rush into it. And there are people that can, if they time it and hit it right, they can have incredible gains instantly. But it's few and far between. More people on altcoins have gotten rug pulled than have benefited. And so there are ones that have been around longer that trade. And so a lot of crypto now, it takes on just like day trading, or it takes on needing to know how to read charts, understand liquidity, understand supply and demand, understand market movers. A lot of the altcoins and a lot of how the cryptos actually trade, the volatility of it follows like a lot of stocks. Okay. So the difference is stocks are owning portions, shares of an actual company. So you have to be aware that some of these altcoins or crypto coins is basically a shell. What is that company providing? It's not providing goods. Is it providing services? If so, what are they? Okay. So that's a place to move money. A lot of potential upside with a lot of danger of downside, volatility, not government backed, money not protected. Okay. Just like stocks, your money's not protected, guaranteed. Okay. So be aware of that. Then you have P2P lending. And this is private lending. And so a place you can move your money is you can move your money into a private lender that lends out money to others. And basically, it's another type of banking, another system of banking that normally is going to have higher interest rates. Okay, but they provide loans that sometimes for people that a bank won't service. So there is peer-to-peer lending. And a way to do this, and we'll talk more about this in the future, is what's called whole life insurance, infinite banking. And so we steward now also a banking system. And so we can steward and do peer-to-peer lending through whole life insurance or infinite banking. And so there is that way as well where you can put your money into another vehicle. So these latter ones that I mentioned, though, whole life insurance, infinite banking, peer-to-peer lending, crypto, commodities, stocks, real estate, and collectibles, you need to grow in your financial literacy and wisdom before you would heavily enter into those, or you can get hurt financially. Okay. So it takes more knowledge and understanding that. One thing that I do like when it comes to the stocks, though, is now that I've begun to be a day trader and began to look to more intentionally steward what we steward and invest, the more I watch, the more I like the S&P 500 tracking funds. And the S&P Standard & Poor is what S&P represents, but the 500 are the 500 largest companies, okay, in America. And if someone begins to no longer be one of those, then they'll get replaced by a company that is. But the S&P went for a long term now, not day trading, not short term, but for the long term, I have personally been impressed with the S&P 500. It allows a form of passivity. You don't have to watch it. You don't have to do a bunch of research on just one stock or 10 stocks or a certain sector. You know, you have the 500 biggest, most valuable companies in America, okay, that represents all different sectors of industry represented there, okay? And that, I think, is a very strong long-term place to put money if you're looking for something that is more passive. When it comes to crypto, when it comes to commodities, when it comes to individual stocks, when it comes to obviously lending, collectibles, it's not going to be very passive. If you want to know what's happening and not begin to be in a place where now it's worth less than what you put in, it's going to take energy and focus. It's going to take attention. So some of these other things I mentioned, like the S&P, would be a form of more passivity, more passive form of investing. All right. I want to end with reading Jesus' words in Matthew 25, verse 14 through 30. He says, "For the kingdom of heaven is like a man traveling to a far country, who called his own servants and delivered his goods to them. And to one he gave 5 talents, to another 2, and to another 1, to each according to his own ability. And immediately he went on a journey. Then he who had received the 5 talents went and traded with them and made another 5 talents. And likewise he who had received 2 gained 2 more also. But he who had received 1 went and dug in the ground and hid his Lord's money. After a long time, the Lord of those servants came and settled accounts with them. So he who had received 5 talents came and brought 5 other talents, saying, Lord, you delivered to me 5 talents. Look, I've gained 5 more talents beside them. His Lord said to him, Well done, good and faithful servant. You were faithful over a few things. I will make you rule over many things. Enter into the joy of your Lord. The joy of the Lord is the 1,000-year reign of Christ, the millennial reign of Christ. What Scripture calls the age to come, before eternity. He also, who had received 2 talents, came and said, Lord, you delivered to me 2 talents. Look, I've gained 2 more talents beside them. His Lord said to him, Well done, good and faithful servant. You have been faithful over a few things. I will make you rule over many things. Enter into the joy of the Lord. Then he who had received the 1 talent came and said, Lord, I knew you to be a hard man, reaping where you had not sown, and gathering where you have not scattered seed. And I was afraid and went and hid your talent in the ground. Look, there you have what is yours. But his Lord answered and said to him, You wicked and lazy servant, you knew that I reap where I have not sown and gather where I have not scattered seed. So you ought to have deposited my money with the bankers. And at my coming I would have received back my own with interest. Therefore take the talent for him and give it to him who has 10 talents. For to everyone who has, more will be given, and he will have abundance. But from him who does not have, even what he has will be taken away. And cast the unprofitable servant into the outer darkness. There will be weeping and gnashing of teeth. Now, the context here of what I just read, Matthew 25, 14 and 30 through 30, is coming out of the end, of course, of Matthew 24. And the end of Matthew 24, Jesus is answering the disciples' question, and they question him regarding the end of days and the sign of his coming. In Matthew 24, he answers those questions the disciples asked him by saying, Watch Israel, who for a time wasn't a nation, became a nation within our lifetime. He says, Watch Israel. Secondly, he says, no one knows the specific day or hour of his return. Then he teaches about the faithful and the wise servant versus the evil servant, which is highlighting character, the importance of our character, the inside of our life, in preparing for his return. Then, after that, he teaches on the wise and foolish virgins. And he distinguished between those that have lamps and oil for their lamps, the wise and the foolish. So he talks about the importance of the light, growing in the light of Scripture, and the oil, the anointing and the ministry and the empowerment of the Holy Spirit. He highlights the wise and foolish virgins and being prepared. Okay. Then it comes to this teaching. What I read, Matthew 25, the parable of the talents, okay? And then this is followed by Jesus talking about judging all the nations. He talks about the sheep from the goat nations. So context, this is all talking about accountability and the Lord's return in the end. And notice what it says. First, it says that everything you and I have received is the Lord's, because the Lord, through his willful obedience, joyful servitude of the Heavenly Father, gave his life. No one took it. He laid it down, crucified, died, buried, but rose victorious. The Father has given him the name above every name, and as his inheritance, he has inherited the nations of the world and all of the substance of the earth. The earth is the Lord's and the fullness thereof. So everything you and I have and everything we've received is the Lord's. That's why he talks about accountability. He talks about working or utilizing the money or the talents we've received, okay, moving our money for multiplication for the Lord. Notice the one who was given 5 multiplied his money into 10 talents. Now, it's an interesting study. You can go study what a talent of gold is and what its equivalent is today. But this is large portions of money, okay? So it's talking about how we gain, how we work, our income, our career, but then how we, when it comes to honoring the Lord in a right money mindset, multiply the money we've received, because the Bible says it's the Lord who gives the righteous and the wicked their wages. In fact, the wicked who are working, it's the Lord in His goodness still providing the means, the method, and the ability for evil or the wicked to work. And so he says then, the money that we have received, it is His, it comes from Him, and we're to honor the Lord with it. So the one that had 5 multiplied the money, got 5 more. So 5 to 10 talents. The one that got 2 talents multiplied it into 4 talents. But then the one who only had 1, he went and dug in the ground and hid it. And the Lord said to him, "You wicked and lazy servant, you know that I reap where I have not sown," meaning the Lord expects increase where He Himself hasn't been before. Jesus Christ, never in the flesh, came to where I live in North Atlanta and the United States. In the days of His flesh, He was born in Bethlehem. He ministered there in the region of Jerusalem. And His ministry, His life on earth was limited there, the days of His flesh, okay, according to the Gospels in Hebrews chapter 1. So because all of it's His, though, He expects there to be increase of what now is rightfully His inheritance, the wealth of the nations. And so anything we have, the Lord expects us to move the money into vehicles that leads to gain, leads to increase. And so the one who didn't, He rebuked. He said, "Look, you're lazy. You're not growing in financial wisdom to honor Me, to take what is mine that I've allowed you to steward and to receive and to grow it for Me." He says, at least you should have deposited into the bank so it would gain interest. Gain interest. So here's the point. The least you and I should do with money is to move it into vehicles where it begins to grow. And yet, the Lord didn't say you should have all your money in a savings account or in a bank. We know that because look at some of the banks that just collapsed. Because you have some unwise stewards in places. You have people running banks or businesses seeking to gain in unhealthy ways who had wrong kinds of debt, entered into agreements without wisdom, and then you see the collapse. So the point is we're going to give an account for what we do with the money we have, and it's not our money. It's actually the Lord's. Whether you acknowledge the Lord as your Lord or not, He is Lord. And whether you acknowledge the money you have as His or not, it doesn't matter. It's still His. And we're going to give an account. So these are some ways you can begin to look at the things I mentioned and grow in knowledge and understanding these different vehicles of where you can move your money now that you move beyond the 10, 10, and 80. God bless you. We'll see you next time. Remember, if money doesn't matter, then what's the matter? If you're not preparing, you're not prepared. This is Chad Craig with Money Mindsets Matter. Please like, please subscribe if you haven't already. Share it with a friend. God bless you. See you next time.